Hi friends, Simit here from InformedTrades.com. In today's video, I want to talk about the crash in the price of oil, arguably the biggest story in financial markets in 2014. I want to discuss sort of the causes of that and where we may be headed for the price of oil, strategies and consequences that investors and speculators should bear in mind. Let's get started. Okay, key points. First, the price of oil has fallen dramatically, especially since the end of July. This coincides with economic sanctions imposed on Russia, which is perhaps a key cause as to why the oil price has fallen to begin with. Shale oil is uneconomical at low prices. Shale oil is the big revolution that's occurred, especially in the United States. It created a lot of jobs, created a lot of oil production from the U.S. It's not economically viable at these low prices. It's the cost of drilling it is considerably higher. The impact of these low oil prices is being experienced in the high-yield credit markets. So we're seeing bonds with a high yield, junk bonds, they're falling in price. And then oil currencies, especially the Russian ruble, which has declined extremely, quite a bit, especially over the past couple days. Big crisis there. Is this whole part of, is the decline in oil price, the rapid decline in oil price, part of a larger political war, a Cold War of sorts? And then what are some potential consequences and strategies that traders should bear in mind? Okay, so the decline. There you can see it now. This is a chart, year to date, basically. You see the entire year. And we can see, especially here, this line here is July 31st, 2014. That's when the U.S. and EU imposed economic sanctions against Russia. And this is for the conflict going on between Russia and Ukraine. The U.S. had imposed numerous sanctions before. This was the third sanction, and that was the strictest one. It came on July 31st, and this is what really sent the price, or coincided with, perhaps it's related to, my hunch is that, there's a relationship here, and there's a political turmoil going on. But once that happened, once the sanctions were imposed, that's when we really saw a decline. Oil fell from, close to 100, right around 100 at the end of July. We are now around 54. So, almost a 50% drop, a little less than that in that time. 80% of U.S. production is uneconomical with oil below $60 per barrel. And here's sort of a chart that illustrates, these shale oil plays. Shale's gotten a lot of attention, especially since 2008. It usually requires an $80 price per barrel. At that price point, shale starts to become economically viable. And this technology, this fracking technology, is not new. It's old. It's just that conventional methods were economically viable. You can get oil at a much lower price until before then, or before now. But now, with conventional oil wells not being as readily available or costing even more, shale is becoming economically viable. So the cost of extracting oil is going up. And that's why shale has come about. So when the oil price crashes, a lot of these companies aren't going to be able to operate profitably. So they're going to have to stop production, which leads to the next point, U.S. employment. So with shale oil not being economically viable, U.S. shale oil or U.S. oil production will decline, presumably. As well, U.S. unemployment may experience some type of a big shift. So you can see that shale states really grew quite a bit in employment. This is still, the non-shale states is the red line, but they're still negative. They've been negative since 2008. It's the green line where the jobs are coming from. And really there's been quite a few jobs, over 1 million jobs created. So are those jobs going to go away? What's happening to them? That's, we'll find out. Impact on other financial markets. So the decline in oil has impacted a few markets. On the screen right now, the candlestick charts are the oil, is the price of oil, crude oil, WTI. This brown line is a Nigerian ETF, or an ETF of Nigerian stocks. Nigeria is a country that gets a lot of revenue from exporting oil. So when the price of oil declines, that's going to affect these types of countries more disproportionately than a lot of other countries that aren't as dependent upon oil. And you can see Nigerian oil ETFs decline considerably. This green line is an ETF tracking high-yield bonds in the U.S. So a lot of oil producers, and we saw the shale oil producers, are going to have some problems now with low oil prices, problems operating in an economically viable fashion. A lot of those companies are issuing high-yield bonds, right? So they're issuing bonds, corporate bonds with a higher interest rate. They're now running into economic struggles. Are they going to be able to pay back those bonds? So the price of those bonds is falling. And we've seen that a little bit. It's not as severe, but we've definitely seen it a little bit, especially starting in November. The decline of oil has been accelerating. This red line here, which is the biggest decline, it's even more than the crude oil decline, is the US dollar Russian ruble exchange rate. So it's inverted. You see the decline of the Russian ruble basically relative to the US dollar. The ruble's lost over half of its value since the start of the year. Pretty big. And that is an idea in terms of strategies that come to mind in terms of how investors or speculators, traders want to play this. These are some ideas. You can look at trade oil directly. You can look at some of these related assets, high-yield bonds, Nigerian stocks, or stocks related to oil-producing countries, or just oil-producing economies in general, as well as the Russian economy, which is related to that. That's pretty significant. Now, that ties into the fact that the Russian ruble declined. That's really gotten a lot of attention, I think rightfully so, because then it may touch upon a broader economic point. Putin has sort of said, the Russian economy can tolerate, or is prepared to tolerate, a significant decline in oil prices for a prolonged period of time. The fact that he made such a statement is sort of like, I personally interpret it as a little bit of a Cold War going on behind the scenes of we know what we're doing, what's going on here, and we're prepared for it. Now, whether that's something else or just an innocuous comment, I guess that's to be determined or a matter of opinion. This article in the Washington Times, I think, relates to a lot of what else is going on. Saudi is allowing falling oil prices to squeeze arch rival Iran. Iran and Russia are sort of one side here. Saudi Arabia, the U.S. are another side. And oil is really, you can see this as an economic warfare. They want to weaken those countries economically by hurting their main source of revenue, which is oil exports. So Saudi Arabia and the U.S. are basically, this is a Pyrrhic victory of sorts if they do end up winning, because all of these countries are dependent upon a higher oil price. Saudi Arabia produces quite a bit of oil. The U.S. is now a leading producer of oil. So Saudi Arabia, Iran, Russia, all these countries are producing a lot of oil. Saudi Arabia and the U.S. are speculating that it's going to impact Iran and Russia more than them. So it's sort of a squeeze to hurt these countries and to gain economic power over them. We'll see how this plays out. Now, strategies in light of all that we've discussed here. Where is this headed? Where are we going? Right now, this video, I've sort of presented a case, or at least my interpretation. This is a Cold War. Now, does it become a hot war? Does it lead to actual conflict? And in times, historically, when there's been conflict over commodities, when there's been a commodity scarcity, and we are going to see decreased oil production, as we saw with the decline in shale, or the inability to produce shale at an economically viable rate. When there's a decline in production, when there's commodity scarcity, that can often lead to countries fighting over commodities. So that can become a hot war. Already there's some economic tension regarding signs that some countries are trying to weaken Iran, Russia, and other countries that are very dependent upon oil. So does this Cold War become a hot war? That's one way of looking at it. And then if you look at, what's the way from a trader or investor's perspective, how do you want to deal with a hot war? How do you want to protect your assets? That's something else to consider. Energy, I think, is the clearest idea. You could also go to gold as a potential geopolitical issue. Buy oil at technical signs of bottom. To me, this is the clearest sign of something that I'm looking for. I think the oil price has to rebound. I don't think I think they're all trying to force oil down, but ultimately it needs to go up. The world is still very dependent upon oil. I don't think there's a realistic substitute that can displace oil very quickly. In light of that, I'm looking for oil, for technical signs of oil bottoming, and then I'm interested in buying oil. I think it can spike back up quite quickly, and I think ultimately the world needs shale oil production. So I think to go above the cost of shale oil production is something I think will occur. And from that perspective, there could be a great opportunity in buying oil at technical signs of a bottom. There's no certainty that it's bottoming yet. I definitely think this is something that you want to look for a range at the bottom, look for a lot of technical signs, and that could be an interesting way of playing it. Personally, that's my strategy for the situation. Deflation trades. With the price of oil declining, oil production declining, you can make an argument that the world is going to deflate. Energy production will be lower, economic production will be lower, so this is an argument for going into government bonds, basically going into the U.S. dollar and going into government bonds. Definitely the U.S. dollar and U.S. Treasury bonds have been soaring while this is going on. If you believe that this is going to continue for a while, then that's really a great trade. Personally, I'm like I mentioned, I'm really interested in buying all the technical signs of a bottom. I'm a little less confident in speculating on deflation for a long-term trend. And also, I think if the Cold War becomes a hot war, that could sort of distort the idea of deflation. I think a lot of government bonds may become unsafe as well. Or I think it becomes a lot less clear what's going to happen. You're going to have textbook deflation where U.S. dollar and U.S. Treasury bonds just rally. I'm not so sure that happens if a Cold War becomes a hot war. So that's about it. Just a quick take on what's going on with the oil market, how it could impact other markets. Again, this is, of course, my take. If you have your own opinion, other information you want to share, questions that you have, join us at informedtrades.com. Best of luck in your trading, and we'll see you next time. Take care.